Hello everyone, welcome back to Money Mastery with Sadik. Last week we had discussed how this week was shaping up to be like a make or break week for Indian as well as for global equities, and that is exactly what we witnessed, right? So let us walk through what happened and what we need to watch out for moving forward as well, right? So this week began mildly positive for Indian equities, but then selling kicked off from Tuesday, tracking US markets as well, right? So once Nifty broke below the 25,650 to 25,700 levels, the index moved toward the 25,450 to 25,500 support level zone, and that is exactly the region that we had highlighted in last week's video as well, right? On Friday, though, the Nifty opened gap down near the 25,300 levels, but then there was strong buying that pulled back the index to higher levels, and then it closed at the 25,500 levels, right? Which is showing that the support zone is held for now, right? Bank Nifty remained relatively stronger despite breaking below the 57,600 support levels on Thursday. The index actually led the Friday's recovery, and also more importantly, from a technical perspective, a bullish engulfing candle has formed in Bank Nifty on the daily time frame, which is a very strong bullish signal, right? FII sold equities worth around 6,000 crores in the first three sessions of this week, but then on Friday they were net buyers of around 4,600 crores of equity, indicating that there's a subtle sentiment improvement when we compare the previous three sessions, right? And domestic institutional investors again continued steady buying through SIP inflows, which is growing, and they added around 16,700 crore of net buying in Indian equities this week. So domestic liquidity remains sort of the anchor for this market, which is providing the much needed support, and that is a trend that we've been seeing over the last few months as well, right? As far as my trading goes, I was positioned largely on the short side since last week. I carried my shorts into the week. I was short like selective stocks in the auto space, the consumer durables, and the e-commerce basket as well, and also had a slight short on the index as well, right? But then on Friday, as the market held the support zone and Bank Nifty started showing a lot of strength, I sort of covered 80% of those shorts and converted the index short into sort of a straddle to sort of neutralize the directional risk going forward into next week, right? So overall, it was a good week for me. So I made around 9% return on the total trading capital and around 14% return on the capital that I had deployed to take these positions, right? Again, I want to emphasize here, I'm sharing this only to explain market structure and the way I position myself around what I am assuming the markets will do. But this is by no way a recommendation, right? This is all done for awareness and education purposes only. As far as the IPO frenzy goes, yes, we are in a frenzy. We did see Lenskart and Grow IPO subscriptions that were closed, and we will probably see them listing this week. And we also have few other IPOs, including Pine Labs and Physics Wala, where the subscription is open right now. And again, as has been the trend over the last few weeks or so, this is a IPO heavy sort of phase, which often sort of leads to valuation excess. And we had briefly touched upon how we are in a frenzy, and we highlighted the Lenskart valuation as well, which is really rich compared to their financials, right? And as ICICI Prudential CIO Mr. Sankar Narain had mentioned in an event yesterday, saying that oversupply of new paper can actually suppress market returns, which is actually what is also happening. So unless FIIs start filling up the gap and starting to like pour money into the markets, this heavy paper supply of new IPOs will put some downward pressure as far as the index return goes, right? And in another event sort of earlier this week, he had also mentioned how markets of late are placing all the risk directly onto investors right, and not on banks or big institutions, which were carrying the risks of volatility, earlier. Big inflows into equity mutual funds, especially into the mid and small cap category, is sort of forcing fund managers to increase their allocation into the sector, while FIIs and promoters are exiting at high valuations, right? So this shows that the market safety nets are getting thinner day by day, and discipline, proper asset allocation tied to individual financial goals, and patience sort of matter more than ever in these market conditions, right? US markets, as we had discussed last week, came under broad selling pressure. Tech and AI names corrected sharply. Nvidia, which hit the $5 trillion market cap, lost around $450 billion of that market cap this week. And also the semiconductor ETF, right, SMH, which is an index of all these AI-led semiconductor companies, sort of continue to weaken this week as well. And another theme that we are seeing is this private credit space, which is also seeing some stress, which is also something that we've been discussing over the last couple of weeks. And the private credit ETF as well softened further. It has been falling for a while since August, but then the selling pressure also sort of weakened. And another key indicator of liquidity stress building up is the US Fed's standing repo facility, the SRF facility, which again saw some usage or borrowing spikes at levels which was last seen only during the COVID pandemic, right? So rising SRF usage means that there is liquidity stress in parts of the US banking or financial system, right? So these signals matter more, and sometimes these can be leading indicators of things to come down the road, right? And this week we also saw DXY, which is the dollar's value versus the basket of other global currencies, sort of strengthening or continuing its strength from late last week as well. That was due to the Fed's hawkish tone. But then midweek, once the private jobs data, the unemployment data came out, showing a lot of weakness, that sort of increased the expectations of further rate cuts starting December, right? Which is sort of putting pressure on the US yields, and midweek started weakening the US dollar, which was evident from DXY losing steam and turning south. And I feel one of the reason that Indian markets sort of strengthened on Friday was also due to this expectations that a weakening dollar and lower yields will result in institutional investors taking risk on more and starting their allocations or increasing their allocations into emerging markets such as India, right? Gold and silver were sort of slightly volatile, but within a narrow sort of range. There have been no aggressive liquidations yet in both the metals, and gold sort of continues to be in the picture as a macro hedge. And I believe traders are sort of waiting for more definite cues with respect to geopolitics and whatever is going on within the US markets relating to the economy, the jobs data, bond yields direction and things like that. Because there were no definite cues from there, gold sort of held on to the narrow range, and silver followed suit, right? But then my expectation is both these metals should sort of correct a bit. I believe for gold, the first level of support will be around the 3,800 levels an ounce, and if that is broken, we might test the $3,700 levels, and there we might see some buying coming in, right? But then overall, I feel that there will be some exhaustion and some selling in gold going into this week and the next few sessions, right? And silver will also be following suit, is what my expectations as well. And we're also witnessing weakness in cryptocurrencies for more than a week now, right? In fact, for a couple of weeks right now. And I sort of have started using cryptocurrencies as a leading indicator of global liquidity conditions. I mean, if you really think about it, when there is a liquidity crunch, institutional investors especially will first start unloading the riskiest assets, right? And from that perspective, cryptocurrencies stand right at the top, and I feel that is what we are seeing, where there is a lot of ETFs unloading their crypto holdings, right, which is adding to a lot of pressure on both Bitcoin, Ethereum, and also the other altcoins as well. So if I overlay Bitcoin versus the S&P 500, we are able to see that crypto sell-offs usually lead equity corrections, and we saw that again this week as well, right? So this is a signal to stay observant. Again, this is not a suggestion for us to increase our exposure to sort of cryptocurrencies or unload it. This is just something that I'm noticing, and something that I've started using as a leading indicator of how global equities might perform. Another key macro event that we might need to follow is this whole US Supreme Court's ruling, the appeal against Donald Trump's tariffs, which is expected to come out end of this year or early 2006. Now, if the tariffs are invalidated or shut down, then that might put a lot of pressure on the US's budget, because they'll have to end up paying back the tariff that they have collected along with the interest, and that will put a strain on their fiscals, which is already bloated with huge amounts of debt that is piling day by day, right? Having said that, we need to follow this keenly, because Indian markets and also the Asian peers had a big impact due to these tariffs, and we might see a knee-jerk spike if the Supreme Court indeed goes ahead and invalidates the tariffs, right? So that is something that we might need to keenly track, and I will make sure I track it and bring any relevant updates with respect to this on a regular basis. So this week showed both stress and last minute or last trading session resilience as far as Indian market goes, and that is also what happened for US equities, because on Friday US equities opened gap down and started showing weakness, but then eventually it ended almost flat at the end of the trading session, right? So supports were largely held, and Bank Nifty is showing a lot of strength, and FII flows is showing some turnaround strength. At least they're not selling in large quantities, right? But then we also need to watch out for the global liquidity signals and also the overvaluation of the AI companies and how they perform, and we would also need to look out for the government shutdown, which is still lingering, and if that is going to bring in some volatility, right? So things are going to be very, very dynamic. We cannot surely predict which direction the market is going to take. We'll have to wait each and every day to understand and digest global macro and micro cues, and then make our trading or investment decisions, right? Having said that, discipline and making investment decisions with clarity and avoiding emotional decisions is very, very important, especially in this very, very dynamic broad macro environment, right? This entire discussion is for educational and awareness purposes only. This is not investment advice or trading advice. Please consult a qualified advisor, SEBI registered advisor, before making any financial decisions. And if you found this video useful, hit the like button, share it with someone who follows the markets along with you, and subscribe to stay updated with market events and other educational and awareness related content, right? Also comment below, where do you think the market is headed next week? If it is going to go up or down based on your assessment or analysis, and also mention what key factors do you think will drive market direction this week, right? I will make sure I respond to those comments personally. Until then, thank you for watching, and see you in the next update or next video.